Welcome back to the desk for this explainer. Look, we are literally 24 hours away from what is, hands down, the most important inflation print of the entire summer. And the market right now? It's completely paralyzed. I mean, we're just drifting sideways, and it's happening because absolutely nobody wants to get caught on the wrong side of tomorrow's data. So we're sitting in this incredibly tense holding pattern, just waiting for that one catalyst to finally tip the scales. So the massive question hanging over all of our heads is just this. Do you buy, sell, or do you just hide? Because look at the reality we're facing today. Futures are totally flat. Oil is suddenly spiking out of nowhere, and a massive market leader like Nvidia is just getting hammered. It's a mess of conflicting signals flashing red and green across the board. So in this explainer, we're going to cut right through all that noise. We're laying out exactly how to structure your tactical game plan for tomorrow morning, figuring out where the smart money is actually hiding, and isolating the exact numbers you need to be watching. All right, let's get into it.
Section 1. The Geopolitical Oil Wildcard. Let's talk about the Strait of Hormuz.
Before we even touch the domestic data, we've got to look at the global tinderbox right now. 20%. Guys, that is the staggering percentage of the entire world's oil supply that passes through that single narrow waterway. When you really wrap your head around that number, you completely understand where the market is just holding its breath. This is the ultimate geopolitical bottleneck, and honestly, it has the absolute power to override any other financial data we get this week.
And what's so fascinating here is just how completely binary the current setup is. Right now, investors are weighing two extreme, wildly different outcomes. On one side, scenario A, you're betting on peace. A diplomatic deal happens, a massive supply of oil floods the market, crude drops maybe $5 overnight, and global stocks rally hard on the sheer relief of it all. But then, on the flip side, we have scenario B. You're betting on chaos. Negotiations collapse, tensions escalate, and oil skyrockets to $90, maybe even $100 a barrel. So if you're long equities today, you are essentially betting the house on scenario A. But if you're long energy, you're bracing for scenario B.
Now, here's the kicker. How the market is actually mathematically weighing these two options. Analysts are telling us the market is already pricing in a 60% chance of a diplomatic deal. This is absolutely crucial to understand, because since a deal is mostly priced in already, the risk is deeply asymmetrical. What does that mean for you? It means a negative headline out of Iran creates way more downside risk for equities than any upside we get from a positive headline. You've got to watch these geopolitical headlines like a hawk, because this wild card could completely derail the next thing we need to talk about.
Which brings us to Section 2, the CPI inflation trap. Let's look at Wednesday's print.
Wall Street is expecting core CPI to hit 3.3%. But because oil is already climbing, you need a very specific if-then playbook based on what actually prints tomorrow. See, even if tomorrow's inflation number looks sort of soft on paper, the market might just look right past it and immediately start panicking about next month's print being inflated by these higher energy costs. So let's break down this matrix. First scenario, if CPI comes in below 3.2%, we get the Goldilocks setup. The Fed gets room to cut rates, tech stocks explode, and you're going to want to buy the QQQ immediately. Second scenario, it comes in right in line at 3.3%. Brace yourself for the whipsaw. The trading algorithms are going to sell first and ask questions later, but human dip buyers will step in. Your play? Wait them out. And finally, the third scenario, CPI comes in hot above 3.4%. Welcome to the stagflation nightmare. High prices mixed with high oil just crushes corporate margins. If this happens, your trade is to sell the rallies and buy energy, specifically XLE for safety.
So, what's the bottom line here? It's patience. Do not, and I mean absolutely do not, make a big bet before 8:30 a.m. tomorrow. You have to let the number print at 8:30, watch incredibly closely to see how the bond market reacts to it, and only then do you pull the trigger. Guessing in an environment like this? Yeah, that's just a one-way ticket to getting burned.
All right, moving to Section 3, trading the Nvidia pullback. The big question, do we buy the dip?
Look, despite being up nearly 150% this year, Nvidia is taking a real hit right now. But let's be clear, what we're seeing is not some fundamental breakdown of the company. It's just plain and simple profit-taking by the massive funds. And there's a really strict rule driving this action. Do not buy it unless oil pulls back alongside it. Think about it. When oil spikes and inflation fears flare up, portfolio managers immediately start rotating out of expensive growth stocks, moving straight into value and energy. Why? Because higher energy costs eat directly into the corporate capital expenditures that actually fuel Nvidia's revenue. So if oil stays high, Nvidia stays under pressure, you just can't touch it in that kind of environment.
But let's look at the flip side for a second. If we actually get a soft CPI print and oil drops, Nvidia is going to be the absolute fastest horse out of the gate. And that makes this specific zone right here,
$400 to $410, a prime, and I mean prime, buying opportunity for long-term investors. Now, if you're a short-term trader, you still need to sit on your hands and wait for the oil news to settle. But for the long haul, this is the exact zone where that risk-to-reward ratio starts to look incredibly attractive.
Section 4. Where smart money hides. Let's follow the cash.
With all of this whipsaw uncertainty going on, just look at the sheer, completely defensive posture the big players are taking while they wait for some kind of clarity. On the buying side, they are scooping up energy, using the XLE ETF as a direct hedge. I mean, if oil goes to $90, these stocks are basically paying you to wait. They're also buying healthcare, the XLV, simply because it's defensive, it's recession-proof, and frankly, it's dirt cheap compared to tech right now. And of course, T-bills yielding 5%. Zero risk, 5% return, a no-brainer for them. But now look at what they are aggressively avoiding. They are dumping small caps, the IWM, because smaller companies are super sensitive to rising input costs. And they are completely dumping consumer discretionary stocks, because let's face it, if oil stays high, the consumer just stops spending. The big players are playing pure, unadulterated defense right now.
Finally, Section 5. Your 24-hour game plan. These are your rules of engagement.
Listen, we are officially in a show-me market. You can't predict right now. You literally have to react. So I want you to write this playbook down. Step 1, tonight, set your alerts for the overnight futures and keep a really close eye specifically on the US dollar index. If you see the dollar spiking tonight, it means safe haven buying is happening and you need to reduce your equity exposure. Step 2, tomorrow morning, skip the first 5 minutes of the CPI release entirely. Just sit it out. Do not try to be a hero here. Let the algos exhaust themselves and wait for that classic 10 a.m. market reversal to show you the actual true trend. Step 3, execute your trade based purely on the data. If inflation comes in soft, you buy NVDA and QQQ. If it's hot, you buy XLE and just sit in cash. Let the data guide you, not your gut.
As we wrap up this explainer, I want to turn it over to you. Looking at this massive catalyst staring us right in the face tomorrow, I want to know exactly how you are positioning your own portfolio. Are you stepping in to buy the dip, or are you hiding in cash until the dust settles? Drop your strategy down in the comments for us. Remember, guys, in a market this paralyzed, patience isn't just a virtue. It is absolutely your greatest weapon. Stay sharp, trust the data, and we'll see who is left standing after the numbers hit.